Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, pay less taxes, have a beautiful retirement. I am one of your co-hosts, Ben Barzideh. As usual, I have my trusty, esteemed co-host with me here, Matt Nadeau.
Hello, everyone.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located right here in Barrington. And we are fiduciaries, and as an independent, family-owned firm, we truly have the freedom to focus solely on your interests, not some corporations or those shady private equity companies buying everything up these days.
Yeah, and of course, we want to just take a minute, say hi to all of our clients who are listening today. We, of course, appreciate the trust you place in us. And we love every one of you. And we have a great show planned for you today. Ben, one of our topics is not going to be the sad state of the United States losing in the World Cup. Unfortunately, we can't talk anymore about that.
No. We're on to other things.
But we're going to talk about something other big that's happened is some more of this news that we're hearing with the U.S. and Iran, the fighting. It's ceasefire doesn't look like it held very long. And is that really a big negative for the markets moving forward? And then later in the show, we're going to actually take a contrarian spin on something you hear out there about Roth conversions. We're actually going to talk about when you should not do a Roth conversion. All you usually hear is do a Roth conversion, do a Roth conversion. We're going to tell you there are times it may not be beneficial for you, so you don't want to miss that.
No doubt. And before we get into it, we just want to announce that we do have some spots left for our workshop coming up this week. It is filling up. It's going to be a fantastic workshop. If you're a retiree or pre-retiree and you want to learn more about our firm, you want to learn more about the new tax laws that went into effect, all the changes that are happening, we're having an exclusive educational dinner workshop at a beautiful local country club next week on Thursday, July 16th at 5:30 p.m. It's complimentary. We're going to go over a variety of financial planning topics. We're going to go over advance and protect, actively managed approach, all good stuff. If you're a retiree, you want to be there, it's going to be valuable info, and you're going to enjoy it while at a refined dining experience in a very pretty intimate setting. So seating is limited. We're already got a ton of people. Last time it sold out. 847-780-2980 or go to bnwealth.com and you can register there.
You don't want to miss it. Anyway, hey, let's dive in. We're going to talk about, it looks like the Iran war is back on, bombs everywhere, the Strait of Hormuz closing back up. Vegans concerned that hummus supplies will be disrupted. It's terrible.
Okay, actually, it kind of feels like it never really ended. That was the weirdest ceasefire ever, if you want to call it that. So, listen, everyone knew it was going to restart. Anyway, we digress.
Yeah, and again, since the expectations and the realization of a ceasefire between the U.S. and Iran was one of the reasons we saw the market rally off of the March lows. It's reasonable, and we're getting questions that people are asking now saying, is this resumption of fighting, are we going to lose any of those gains that we had in the last quarter? And despite the logic in that expectation, based on the facts that we know right now, the resumption of tax not likely to be like a significant disruption to the market. And we're going to explain why. So once we start talking about geopolitical situations, market, remember, only cares about how it impacts resource prices, and namely oil. And the escalation of hostilities this week is unlikely to create a sustained rise in oil. And it means if that's not the case, we shouldn't see a material negative for stocks.
Now, yes, we could see oil rally back towards $90 a barrel on a continuation of escalation of fighting, but it's really unlikely to move substantially higher or sustainably higher, primarily because it does not appear that the U.S. is interested in a dramatic escalation of hostilities, something like a la Iraq-style invasion where you send tens of thousands of troops there. That's always been the worst case scenario. And despite President Trump's finish the job comment this week, that likely means just more direct strikes on strategic targets in Iran. So even if hostilities picked up significantly, we're still likely looking at a realistic worst case scenario of just disrupted transit through the Strait of Hormuz, but not a total cessation that lasts many months, which is, I think, what it would really take to drive oil back into like the mid 100 range again. So, no one's expecting that.
Yeah, and more technically, since the onset of the war in March, global oil producers actually have started taking steps to alleviate that reduction in oil supplies, given all of those Strait of Hormuz transit issues. So even earlier this week, OPEC increased production quotas globally, while since the start of the war, even Gulf states have increased pipeline usage, especially we're talking Saudi Arabia and UAE, and that's now carrying 8 million more barrels out of the Gulf, while production in Venezuela is also rising. So again, these measures alone aren't enough to offset any substantial blockage in the Strait of Hormuz, but the longer term trend in oil supplies is higher. And if we're barring any major disruptions of the Hormuz transit, like at the start of the war, where there's no end in sight, then any rise in oil prices we really would see being contained. And we wouldn't really see it materially going above $80, or I'm sorry, $90 a barrel.
Furthermore, I think Americans got to witness over the past few months that once the flow of oil does normalize, it can quickly bring down oil prices again. So if that happens again, there's some precedence. It's not like it was 3 months ago where it was just happening then. However, and this is a big but, don't confuse the commentary that we're talking about to imply that the resumption of fighting will have no impact on the markets, okay? If oil prices do rebound and settle maybe in the $70 to like $90 a barrel range, there are three ways it could add headwinds on the market, but not be enough to cause like a super big decline all by itself. So first, higher oil prices will boost inflation concerns. Second, those inflation concerns will boost expectations for multiple rate hikes. Third, those factors would combine to push Treasury yields higher, which would become its own headwind on stocks. So we don't need that right now. Hopefully that doesn't happen.
Yeah, we don't need any of those things like additional rate hikes. The poor new Fed chairman trying to do rate hikes, could all of a sudden Trump's sending him the same kind of angry messages like he used to for Jerome Powell.
Giving him the business.
It's like, I just put you in.
Yeah.
Anyway, from a level standpoint, there's a couple key indicators we're watching. One, of course, we've been talking about oil, so Brent crude, and the second is the 10-year Treasury yield. So for Brent crude, we're really looking at keeping an eye on a resistance level of 83.86, which that's the high from the gap, lower in oil when following that June 14th ceasefire agreement. So that's a level we're watching. If we see a close above that level, we'd be worried there would be additional upside. And then if we look specifically at the 10-year Treasury yield, watching what the bond market thinks, if we look at the year-to-date high, which was at 4.69%, so almost 4.7, that's a key level to watch. If we broke above that, now we would be worried we'd be running closer to a 5% level, and that would increasingly add a headwind on stocks we'd be worried about.
No doubt. And here's something else. This is like one of those wise nuggets of info we're about to depart on you, kind of like a good fortune cookie. All right. The market tends to discount the same negative news only once. Here's what we mean. When a concern arises, it initially sends the market into a panic, as investors usually overreact. Then things settle down, investors accept it, and the world moves on to the next concern. So that's another reason, in our opinion, we're not seeing the market react as negatively to resumption of the fighting as maybe we did back initially in March. And we are bullish right now. So we haven't taken our foot off the gas in a lot of our advance and protect actively managed models that we utilize for our clients. We manage them in-house. We are 100% pedal to the metal in equities. We're intelligently diversified in the areas where we're seeing momentum and strength. However, we monitor our investment positions every single day, and it can quickly react if necessary. So if things get worse, we will get defensive by actually selling out of the stock market and go heavier into bonds or cash while we wait for things to improve, which is kind of what we did for about 3 weeks there back in March, April.
Yeah, and here's the thing, if you wanna learn more, we've had the big news, the big announcement. Want to learn more about our Advance and Protect, you want to learn about our firm, like we have a wonderful exclusive educational dinner workshop. It's at a beautiful local country club. It's coming up this Thursday, July 16th at 5:30 p.m. You don't want to miss it. It's going to be fantastic. We're running out of time. It's filling up. During this event, we're going to cover how new tax laws could impact your IRAs, required minimum distributions, things you wish you knew before receiving an inheritance. We're going to talk about tax reduction strategies, Roth conversion strategies, and of course, our Advance and Protect actively managed process. It's going to be wonderful. You're going to get all this great information. You're going to have a wonderful dinner, a refined dining experience, but seating's limited. We're running out of time. It's this Thursday. Call us at 847-780-2980 or visit bnwealth.com to sign up right away. And when we come back, we're going to talk about when you should not do a Roth conversion. You don't want to miss it. Welcome back. Thank you for tuning in. This is Money Hour Radio. It's a show where we try and help you grow your money, pay less taxes, and have a beautiful retirement. And I'm one of your hosts, Matt Nadeau. I have with me, of course, my esteemed co-host, Ben Barzideh.
Hello, everyone.
Yeah, and we're founding partners. We're wealth managers at Barzideh and Nadeau Wealth Management. It's a local, comprehensive, independent financial planning firm. We're located right here in Barrington, and we're here to serve the greater Chicagoland area.
And before we start the next segment, we just want to go over some big stuff. We are having our wonderful workshop next week at a very fancy steakhouse. So if you're a retiree, pre-retiree, and you want to learn more about us, you want to come to that. So it's going to be an educational workshop with dinner Thursday, July 16th at 5:30 p.m. at a beautiful local country club. And during this complimentary event, we're going to go over the new tax laws, how they impact IRAs and required minimum distributions, what everyone wished they knew before receiving an inheritance, tax reduction, Roth conversion opportunities, the biggest risks retirees face in the year ahead. And of course, we're going to talk about our Advance and Protect actively managed investment approach. So all of this valuable information, seating is limited. It's already almost packed. You can give us a call to RSVP at 847-780-2980 or visit bnwealth.com to register there. We definitely look forward to welcoming you on July 16th.
All right. Well, listen, if you come, you're going to meet us. Say hi at the event. Let us know you listen to us on the radio. We love to meet listeners, know that you're out there. So just give us a call. We'd love to meet you. Come say hi. All right, Ben, let's switch this up. One of the things we're going to talk about at our workshop is Roth conversions. But today, we're going to talk about when you shouldn't do a Roth conversion. Because, right, it's one of the hottest topics you're going to hear in retirement planning, Roth conversions, specifically to Roth or not to Roth. That's the question. So if you spend any time on YouTube, social media clips, you've probably heard some talking head enthusiastically saying, everybody should do a Roth conversion. Well, so not exactly, but Ben, aren't we talking heads too?
Yeah, listen to us, though. Don't listen to them.
Yeah, that's right. Listen, Roth conversion is like a little like hot sauce. For some people, it's amazing. For others, it's just leave them asking, why? Why did I put so much of this on my burrito?
So for today, we're actually going to reverse that question and discuss when you shouldn't do a Roth. And of course, towards the end, we're going to cover a little bit on when it does make sense, in our opinion, to do a Roth conversion. So generally speaking, if you've listened to our show, you know, we actually love the concept of Roth conversions. And when done right, it can be a very powerful financial planning strategy, but it is far from a one-size-fits-all solution. And while converting assets from a traditional IRA or a qualified retirement plan into a Roth IRA offers the potential for tax-free growth and tax-free qualified withdrawals, the decision should be based on a multitude of factors, regarding the individual's current situation, future income expectations, retirement goals, and also estate planning objectives.
Yeah, so let's just stop and think, because there's many cases where we see a Roth conversion potentially creating unnecessary tax consequences that when you weigh it, it's actually outweighing the benefits. So first, one of the most common situations we see where a Roth conversion does not make sense is when an individual will actually expect to be in a lower tax bracket during retirement. So say you're still working and you're in a higher tax bracket, paying taxes today at these higher marginal tax rates could be less advantageous than just simply withdrawing those funds at a lower rate in the future. So for retirees whose taxable income will decline significantly, let's say after leaving the workforce, preserving that traditional IRA can end up mathematically being a more tax-efficient choice for you. So in other words, let's think about this. Let's say you've got a higher paying job, you're paying taxes at 32% right now. So you go to do these Roth conversions and you pay 32 cents on the dollar now to avoid potentially, paying them only at 12% in the future. It's kind of been like paying full price candy or Halloween candy the day before Halloween when you know it's going to be 75% off the very next day. Just hold on. Wait a minute.
No doubt. Okay. So number 2, here's another situation where you want to pump the brakes, okay, on the Roth IRA. That is when you don't have cash available to pay the taxes. So a Roth conversion may be inappropriate for individuals who are in that situation. They lack sufficient non-retirement assets to pay the resulting tax bill. So ideally, the taxes generated by conversion should be paid from outside accounts, like from cash or taxable savings, rather than from the retirement account itself. And using retirement assets to cover the taxes reduces some of the benefits of the conversion and may even, get this, trigger extra additional penalties if you are under age 59 and a half, if distributions are used to cover that tax liability.
Yeah, that ends up being a really bad decision there. And then maybe worst of them all is this deluxe package of what I call unintended consequences. It's the domino effect. It's like you light one firecracker and then it's another one, and it's a chain reaction. So here's what we mean. Let's say you go and you convert a big chunk of money. Now suddenly your tax bracket jumps considerably higher, and then you'll see sometimes your Medicare premiums increase a couple years later through something called IRMA, income-related monthly adjustment amounts. And then you might also see more of your Social Security becomes taxable. And then you start seeing certain deductions or credits disappear faster than when we put free donuts in the break room, right, Ben?
No doubt.
So
anyone who's worked in an office setting knows that, right?
It's like, oh my gosh, they're gone. And that's where we start seeing ripple effects can significantly increase the true cost of what the conversion is.
No doubt. Okay, now, before you go thinking we're anti-Roth conversion people, we want to remind you that we absolutely love them in the right circumstances. Sometimes they're fantastic. So let's look at those circumstances. One favorable scenario is when an individual is temporarily in a lower than normal tax bracket. Suppose you just retired but haven't started Social Security yet, and your required minimum distributions from your traditional IRAs and 401ks are still years away. Guess what? Congratulations. You have now entered what we lovingly call the Goldilocks Zone for Roth conversions. That's because your taxable income in this situation might be lower than it'll ever be, making it, again, a great opportunity to convert portions of your traditional IRA while paying taxes at a relatively low rate. Then you have the ability to take out tax-free qualified withdrawals later in life when your taxes will be probably higher.
I love the Goldilocks zone. So here's another good reason. Let's say your future tax rates are going to be higher than they are today. At least that's what you believe. So a Roth conversion can be attractive for individuals who do expect their tax rates to rise in the future. So that either be because you're anticipating increases in your income or potential changes in tax laws. And maybe you get some kind of big inheritance that could trigger it, like, some of those annuities you're going to pay a bunch of taxes on when you pull it out. So paying taxes now at a known rate may actually provide greater certainty and reduce your future tax exposure. Think of it like tax insurance. And additionally, if you're an individual with substantial retirement account balances, you could actually use these Roth conversions to manage those future required minimum distributions, and that can help manage your taxable income later in retirement.
You're basically tax-proofing your situation in case AOC becomes president, right? All right, lastly, we joke, we kid. All right, actually, that might happen. God help us. No, I'm joking. All right, lastly, let's not forget estate planning as the reason why. Many people like leaving Roth IRAs to their heirs because qualified withdrawals are generally tax-free. So this is particularly valuable for those beneficiaries in higher tax brackets. Leaving a Roth means you are passing on a tax-free legacy to your kids instead of dumping a potential tax time bomb on their laps. That could actually cause them to go into even a higher tax bracket than they currently are in.
Yeah, and a lot of times we see this for an estate planning. Like, let's say your estate's very large. Paying the tax now can actually help reduce your estate, which could also save taxes for your heirs. So for legacy planning, it can be pretty powerful. So, bottom line, the takeaway, internet always loves simple answers. Do this, don't do that. But when you're dealing with your own personal finances, your real financial planning, it doesn't work that way. It's not black and white. So a conversion to a Roth isn't automatically good or automatically bad. It's just a tool. You need to use it, like a hammer when you need to hammer a nail, like you're building a house. But it's much less useful if you're trying to iron a shirt or something like that.
A lot harder.
So the right decision depends on your income, tax bracket, retirement timeline, your cash flow, Medicare situation, your estate planning goals. All of this is unique. And you do need to look at even where the future tax laws may go.
No doubt. So the best approach is one that is tailored to your overall financial plan rather than assuming a Roth conversion is just universally beneficial. And as with any financial planning, investing, or strategy, you want to work with qualified professionals. If you want to work with us, you should actually, hey, big news, Matt. Tell them about where they can come meet us.
Well, we've got that big dinner workshop. We're running out of time today, but this is the last chance we have to announce it because it's Thursday, July 16th at 5:30. This coming Thursday, we're going to talk about all of these financial planning topics like Roth conversions. We're going to talk about the new tax laws, how they impact your future retirement required minimum distributions. We're going to talk about our advance and protect process. It's all wonderful information while you enjoy a refined dining experience and you get to meet us. Seating's limited. We're almost there. Reserve your spot by calling 847-780-2980 or go to bnwealth.com. Hope to see you there. We're out of time. We'll see you next week.
God bless everyone. Take care.